The Commercial Real Estate Show is brought to you by Cohn-Resnick, forward-thinking advice to navigate business and financial issues. Visit cohnresnick.com. By BB&T, banking, business, and commercial real estate loans. Visit bb&t.com. And Arnold Golden Gregory, a law firm that makes a difference. Visit agg.com. And Bull Realty, when your business requires proven performance, visit bullrealty.com. And by France Media, providing exposure to the world of commercial real estate. Visit francemediainc.com. Welcome to the Commercial Real Estate Show. Thanks for joining us to lead, learn, and laugh. Learn market knowledge and best practices to lead to your company's success. And that's whatever type of company you work with and laugh, I think we have to have some fun along the way. Well, hello, I'm Michael Bull, your host to the world of commercial real estate. Well, today we're going to explore the U.S. retail market. You know, retail has been reported as the trailing sector in commercial real estate. Well, has the sector turned the corner to recovery? And when will new development return in full swing? And just how are retailers doing in this world of internet sales and multi-channel customer interaction? And how are retail investment sales faring in this environment? And finally, where are the opportunities? Well, we'll find out today. First, please welcome my guest, Dan Fasulo, Managing Director, RC Analytics. RC Analytics does a great job focusing on income-producing properties, office, industrial, retail, apartment, and hotel, plus sales of commercial sites. They look at sales of over 2.5 million or greater in the U.S. and 10 million or greater outside the U.S. Since 2007 alone, RCA has recorded over 5 trillion in commercial real estate deals throughout 126 countries. Dan Fasulo, thanks for joining us.
Thanks for having me, Michael.
Well, Dan, thank you. I know it's cold up there in New York, but I know you're all charged up. What'd you say it is, 10 degrees there this morning?
It is the coldest it's been all year.
Okay. Well, before we get to investment sales, Dan, how did the U.S. retail sector overall perform in 2012?
We definitely moved into a period of stabilization. All reports are that fundamentals have stabilized in most markets nationwide. We're not seeing huge declines in occupancy anymore. We're not really seeing rents plummeting. There might be certain submarkets that are still pressured, but all in all, fundamentals have stabilized. On the macro side, even despite kind of lower consumer confidence recently, retail sales have held up somehow, and they have been pretty good over the last few months considering the environment. But to speak of retail real estate in general terms nationwide is really difficult because it's really a dozen or more different sub-segments. Even within markets themselves, there might be a half a dozen different, not only geographical submarkets, but different types of assets that are actually performing completely differently in this recovery so far.
Yeah, that's a very good point. You can look at the one project in town area doing really well, the identical project 3 miles out of town, and it's suffering. And we're going to get to that a little bit. But you say we're past the tipping point. We're on the road to recovery. Can I do the Snoopy dance yet? Where are we headed for 2013? What do you expect?
Well, I think we'll see some incremental growth. The U.S. economy is like a big ship. Once it's going in the right direction, it's hard to turn it back around. You can't get away from the economy too much because at the end of the day, consumer spending is a huge component of the economy, and it's a huge driver of retail real estate. If the retailers aren't expanding, it doesn't bode well for someone that lost a Circuit City in their shopping center a couple of years ago.
Right. Well, let's look at sales volume in 2012. Were retail investment sales more robust than previous years?
We had a solid year. I think you mentioned it in your intro that retail on the investment side had been lagging the other property sector. In 2012, it started to catch up, especially in the the major markets around the country. Think your gateway cities. We've seen a massive amount of capital, both on the equity and debt side, flow into retail real estate. We call them the 6 major metros, saw investment activity up 54% year over year, 2012. Some of the favored property niches were certainly that in town, that urban storefront type of product that has become very hot. I'm sitting here in Manhattan, and we're seeing all-time record highs for rental rates and values for any type of retail on the street in that urban type environment. And we're also seeing those similar trends in top submarkets around the country, especially in those kind of live, work, play environments. Another segment, which has kind of surprised me to some extent, has been your trophy malls. It seems like the top 1 or 2 malls in most major markets around the country are seeing significant investor demand right now. It's really the second and third tier malls right now that are really struggling.
Right, that's a good point. Some of those malls are dying, and some are just extremely popular and doing well and getting in great rents. And we're talking with Dan Fasulo with RC Analytics. And Dan, what about cap rates? Where did cap rates end up for various retail property types in 2012?
Yeah, cap rates among the property sectors saw among the most amount of compression in 2012. Now, as we said before, retail has kind of lagged the other sectors, and what happened was a real gap, a huge spread opened up between, cap rates for apartments and top office properties and retail over the past couple of years. So, some really smart money has placed a lot of big bets on the retail sector and really helped to drive cap rates down in 2012. I expect some additional cap rate compression for the sector in 2013, as that spread is still going to have to close over time.
So what are some example cap rates that you saw at the end of 2012, and how do you expect that to change in 2013?
Yeah, nationwide, we're a little above 7% for cap rates for the retail sector. Obviously, if for your top quality, institutional quality properties on the coast, you're looking at much lower than that. That type of yield looks awfully attractive to especially institutional investors, which, when you're looking at your other asset classes out there, especially the risk-free, the 10-year government bond, I think you're going to see a lot of capital attracted to the retail sector because of the high yields available right now. Okay.
And as those cap rates do get compressed in some of those major hot core properties, do you expect to see more capital flowing into, say, lesser quality assets, and how might that affect cap rates moving forward?
It's already starting. And, I took a look at our stats before the call, and I was really surprised to see, like the unanchored retail properties. We saw, a surge in activity for those at the end of the year, which means that, investors and certainly local developers and owner-operator types are really expanding beyond the top properties in their market to, possibly position themselves for the uptick over the next couple of years. But I have to caveat that kind of secondary asset activity is really heavily focused on just the best markets right now.
Right. That's a good point. Well, Dan, you guys at RC Analytics, you've studied the market for a long time. What stands out as most interesting to you in the current market we're in?
Oh, God. There's we're talking retail. There are trends in the retailing industry. You alluded to some of them in your intro that are really just changing the whole dynamics of the underlying real estate. And investors and obviously the retail tenants themselves are trying to position themselves for the future. and it's really having a huge impact on values nationwide. And it's happening, I think, faster than any of us would have forecast. It's almost like the Apple Store effect, that retailers in the future are going to have fewer and fewer locations to some extent, but be willing to pay more and more for the best locations. As it's not necessarily about just making X amount of sales from this geographic location. These shops almost become advertising and marketing tools for a customer who comes in and then goes to the internet and makes a purchase. That's somewhat evident by the massive increase in internet retailing we saw over this last holiday season. It's really blown my mind.
Well, some good points. And Dan Fasulo, thanks for joining us today. We surely appreciate your insight.
No problem, Michael.
All right, if you'd like more information from Dan Fasulo and the good people at RC Analytics, visit rcanalytics.com. After a quick break, we'll get more perspective on the U.S. retail market. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back.